You drive past a $4 million mansion in Calabasas, now relisted around $1.8 million. The pool is still shimmering, the 6-car garage still gleams, the stone entry still looks like a magazine cover. But the driveway is quiet, and the listing has been sitting for months. Welcome to California in 2025, where luxury homes are not just correcting, they are being repriced around risk, insurance, and carrying costs in ways that would have sounded impossible a few years ago. In this video, we are taking you through 10 cities where high-end properties that once sold for $2 or $3 million are now being offered for far less, and yet many still struggle to find a buyer. These are not cheap bargains. They are complicated assets with serious baggage. We are going to look at places where association rules collide with rising costs, where wildfire and flood maps have redrawn the whole idea of coastal safety, and where some owners are discovering that getting insurance at any price is no longer guaranteed. Along the way, you'll see which cities are experiencing the sharpest resets and why even a 50% discount can still be a dangerous entry point. If you care about understanding the next phase of the housing market, not just the headlines, take a moment to like this video and subscribe to Discover the Nation. We dig into the real numbers, the policy changes, and the climate risks behind the dream so you can protect your future. Now, let us start this tour.
Number 10. Calabasas. You roll into Calabasas expecting celebrity sightings and spotless luxury. Gated communities line the hills, guard booths and palm trees frame the streets, and every home seems to have a view, a pool, or both. For years, this area symbolized aspirational Southern California wealth. In 2021 and 2022, many properties here were listed well above $4 million. Today, you can find examples that have been marked down into the low $2 million range or below, yet they still linger on the market. Recent data shows high-end homes in and around Calabasas sitting well over 100 days before going under contract, in some cases far longer. That is a dramatic shift from the rapid sales of just a few years ago. One of the main drivers is insurance. Portions of this region sit in high wildfire risk corridors and near areas with evolving flood and storm runoff concerns. Over the last several years, multiple major carriers have reduced their appetite for new business in higher-risk parts of California or tightened their underwriting standards. Buyers shopping in Calabasas routinely report fewer options, higher premiums, and stricter conditions. In some cases, they are advised to self-insure for part of the risk or rely on limited last resort policies. For a potential buyer, that means more than just a larger monthly bill. It means asking a fundamental question. If a future fire season or severe weather event damages this property, how much of that cost is truly covered? Lenders ask the same thing when deciding whether to finance a purchase. At the same time, association dues in many gated neighborhoods remain substantial, and rules can be strict. Exterior changes, landscaping, even paint colors are often heavily regulated. The result is a strange disconnect. On the surface, Calabasas still looks like a curated lifestyle. Underneath, the combination of higher insurance costs, stricter risk assessments, and elevated upkeep is shrinking the pool of buyers who are ready to take on a multi-million-dollar obligation. If this is the opening chapter of a broader luxury adjustment in Southern California, it is worth paying attention. Would you commit to that kind of property if insuring it felt uncertain?
Number 9. Beverly Hills. You descend from the ridgeline into Beverly Hills, a name that has signaled wealth and prestige for generations. Tree-lined streets, iconic shopping districts, and grand homes have made this one of the most recognized luxury markets on Earth. Yet even here, the math is changing. Since the peak of the last cycle, median prices in the upper tiers of the Beverly Hills market have retreated significantly. Homes that once commanded $6.5 million can now be found asking figures closer to the mid-3 million range in some cases, and still they may sit unsold. That is not simply about aesthetics. It is about the true cost of holding these properties. Annual property taxes on high-end homes routinely reach into tens of thousands of dollars. Maintenance for large houses with mature landscaping, pools, and older systems can add another substantial layer. Energy costs, staff, security, and association dues in certain private streets all stack on top of the mortgage.
For some owners, the carrying cost each month rivals what many households across the country pay for an entire home. Insurance has become another stress point. Wildfire risk in the broader hills and canyons has led to rising premiums and closer scrutiny. Some properties, depending on location and construction, have seen steep increases or more limited coverage options. When potential buyers model those costs over 10 or 15 years, many rethink how much home they actually want. At the same time, policy changes and local regulations have made short-term rental strategies far more restricted, removing a potential income offset for some would-be owners. Strict permitting requirements and high fees for even relatively modest renovations add friction to any plan to update or reposition an older property. The end result is a neighborhood where the name still carries tremendous brand value, but the pool of buyers who can comfortably support the full cost of ownership and who are willing to accept the associated risks is smaller than it was during the ultra-low interest rate era. Beverly Hills has not lost its identity, but its luxury market is being forced to adjust to a new reality.
Number 8. Malibu. You roll along the Pacific Coast Highway into Malibu, where homes sit on bluffs above the water or directly on the sand. For decades, this stretch of coastline represented the ultimate expression of Southern California luxury. In 2025, it has become one of the clearest examples of how climate risk and insurance retreat can reshape even the most exclusive markets. During the last boom, it was not unusual to see beachfront homes trade at $7 million or more. Today, some of those properties have been repriced significantly lower, yet still sit active. One reason is erosion. Rising seas, powerful winter storms, and changing coastal dynamics have eaten away at parts of the shoreline. Properties that once had a comfortable margin between deck and water now find that dividing line much closer. Insurance availability has changed in tandem. Over recent years, many private insurers have scaled back their exposure in the highest-risk coastal zones, especially where wildfire, landslide, and flood risks overlap. Owners who previously relied on a mix of private coverage now find themselves pushed towards state-supported or specialized policies that can cost tens of thousands of dollars annually and still leave important gaps. Flood coverage is often separate and not always available on the same terms. Updated federal and state risk maps have placed more of Malibu into higher risk categories, influencing both insurance and lending decisions. For a buyer considering a multi-million-dollar home here, understanding what is and is not covered has become just as important as the view. Lenders may require specific coverage levels as a condition of financing, and if those requirements cannot be met at an acceptable cost, transactions stall. These physical and financial realities are altering behavior. Some longtime owners are choosing to quietly list and move inland or to other states. Others are holding, but investing heavily in mitigation work, from seawalls to slope stabilization, projects that are themselves subject to regulatory approvals and ongoing maintenance. Malibu remains visually spectacular, but it is no longer simply a story of ever-rising prices. It is a case study in what happens when the cost of managing risk begins to rival the cost of the property itself.
Number 7. San Francisco. You cross the bridge into San Francisco, a city that for years seemed to define the idea that real estate wealth was almost guaranteed if you could buy and hold. In 2021, historic homes in many of the city's premier neighborhoods commanded prices that felt unreachable for most buyers. By 2025, that narrative has shifted. Reports show median prices for certain historic single-family homes have fallen sharply from their pandemic-era peaks, with some properties now listed near or even below the seven-figure line, after previously selling for more than double that amount. In a few notable cases, homes have gone through multiple price cuts and still struggled to attract serious offers. Why? The cost of ownership in San Francisco extends far beyond the purchase price. Annual property taxes on a multi-million-dollar valuation can reach significant amounts. Insurance premiums have risen as carriers factor in earthquake exposure, aging infrastructure, and regional wildfire risk. Some policies exclude key events or require substantial deductibles, leaving owners to cover more of the potential loss. At the same time, daily life considerations weigh on buyer sentiment. Reports of property crime, concerns about safety in certain commercial corridors, and visible challenges related to homelessness influence decisions about where and how people want to live. Even in traditionally affluent neighborhoods, increased break-ins or slower response times can impact perceived value. Regulatory complexity adds another layer. Preservation rules, planning requirements, and detailed building codes mean that changes to older homes can require significant time and expense. Owners who hope to renovate or expand quickly may find themselves navigating lengthy review processes. All of this produces a market where entry prices are lower than they were at the peak, but the commitment is still substantial, and the path to adding value is more complicated. For some buyers, that presents an opportunity. For others, owning in San Francisco in 2025 feels less like a guaranteed win and more like a high-stakes long-term bet.
Number 6. Napa. You glide into Napa Valley expecting serene rows of vines and effortless luxury. For many years, high-end homes tucked among vineyards or overlooking hillsides offered a distinct form of California wealth, tied to both lifestyle and agriculture. In the last few years, that picture has changed. Listings for properties above $2 million have declined significantly in number and in price from earlier peaks. Estate homes that once set comfortably above $3 million have returned to the market at far lower asking prices and still can take many months to sell. Wildfire risk is central to this shift. State fire maps now classify large portions of Napa County as high or very high threat zones, reflecting recent fire seasons and ongoing vegetation and weather patterns. Insurance premiums in these zones have risen accordingly, with some homeowners reporting annual costs well into 5 figures for comprehensive coverage. Additional policies for earthquake and flood, where available, push total risk management costs even higher. Water is another pressure point. After multiple dry seasons, groundwater and surface supplies have come under strain. Some wineries and rural properties have had to truck in water at considerable daily expense to maintain operations. For a buyer considering a property with vines or extensive landscaping, long-term water security is not just an environmental question, it is an economic one. Maintenance and infrastructure issues can also be significant in rural luxury markets. Long private drives, aging wells or septic systems, and older structures all require ongoing investment. As borrowing costs have risen, the number of buyers willing to finance both a large purchase and substantial yearly operating costs has declined. Napa still offers beauty, culture, and a unique lifestyle for those who can afford it, but its luxury housing market is now intertwined with climate pressures and resource constraints in a way that is impossible to ignore.
Number 5. Santa Barbara. You arrive in Santa Barbara with its red tile roofs, palm-lined streets, and dramatic meeting of mountains and sea. For decades, it has been marketed as a postcard-perfect blend of Mediterranean style and California coast. Beneath the views, however, the risk profile has been evolving. Heavy storms and repeated flood and debris flow events in recent years have reshaped both the physical landscape and the regulatory maps. Updated flood designations have placed more of the region, including parts of nearby Montecito, into higher risk categories than before. Luxury homes that once commanded between $2 and $3 million have in some cases been repriced significantly lower to reflect both physical damage history and ongoing risk. Some cliffside properties have experienced measurable ground movement, leading to dramatic images of structures shifting or requiring emergency stabilization. Insurance providers have taken note of these patterns. In certain zones, flood coverage has become more expensive or difficult to obtain, and some private insurers have reduced their appetite for high-risk coastal and hillside properties. Owners may face a choice between raising structures, investing in major mitigation measures, accepting much higher premiums, or carrying more risk themselves. Local building and planning rules designed to protect views and manage development add another layer of complexity when owners seek to repair or rebuild. Permitting can take many months, particularly when proposals intersect with environmental reviews or neighboring view protections. The combination of higher risk awareness, rising insurance and construction costs, and regulatory constraints has cooled demand at the upper end of the market. Santa Barbara still offers extraordinary scenery and amenities, but buyers are now approaching with a sharper eye on resilience, long-term safety, and the true cost of ownership in a changing climate. Number 4. Laguna Beach. You pull into Laguna Beach, an arts-focused coastal community built into steep hillsides and wrapped around sheltered coves. The views are stunning. Galleries, cafes, and narrow streets create a unique atmosphere that has thrilled visitors and residents for generations. In 2025, though, the luxury housing market here is facing a different reality. High-end homes that once sold confidently above $3 million are now staying listed far longer, with multiple price adjustments becoming more common. Median days on market for some segments have climbed past 4 months, a clear signal that the old pricing assumptions no longer hold. The terrain is a major factor. Much of Laguna Beach is built on slopes and bluffs that require careful monitoring. After periods of heavy rain, geologists and local officials have documented slope failures and ground movement in certain neighborhoods, leading to red-tagged homes and expensive stabilization work. These events make both buyers and insurers more cautious. Insurance companies have increasingly excluded ground movement and earth-related events from standard coverage, categorizing them separately from fire or wind. That means owners may pay substantial annual premiums and still face significant out-of-pocket exposure if a hillside shifts or foundational issues emerge. Associations in some communities have responded by commissioning engineering studies and investing in retaining structures, costs that may be passed on to homeowners through special assessments. Sea level rise and storm-driven wave action have also affected beach access and coastal infrastructure. Stairs and paths that once led comfortably to the sand have had to be closed or rebuilt. Municipalities walk a fine line between maintaining access and ensuring safety, and legal disputes sometimes follow. For prospective buyers, Laguna Beach remains one of the most visually compelling places in California. But the current environment demands a level of due diligence that goes beyond the usual inspection. Soil reports, insurance terms, association reserves, and local hazard histories are now central pieces of the decision, not afterthoughts.
Number 3. Palo Alto. You arrive in Palo Alto, long viewed as the heart of Silicon Valley wealth. For years, modest-looking homes on quiet streets sold for extraordinary sums simply because of their proximity to major technology employers and schools. That dynamic has shifted. In the luxury tier, listings that once pushed $4 million and beyond are now being reduced significantly from their pandemic-era ask. Overall volumes in the very high-end brackets have dropped, and some properties remain on the market far longer than owners or agents would like. Several forces are at work. Major technology companies have gone through waves of restructuring and layoffs. Some roles have moved to other regions or shifted to permanent remote arrangements. That has reduced the immediate pool of buyers who both want and need to be within a short commute of specific campuses. At the same time, remote work options have allowed some households to relocate to lower-cost areas while retaining their incomes. Property taxes on expensive homes in Palo Alto remain substantial, and insurance costs have been influenced by updated assessments of earthquake and fire risk. When buyers factor in the total yearly cost of owning, including taxes, insurance, and necessary upgrades to older structures, the headline price takes on a different meaning. Regulatory processes can also be lengthy. Stories of extended permit timelines for renovations are common. Projects that would be straightforward in some regions can require extensive review, especially when they involve structural changes, additions, or potential impacts on neighborhood character. This does not mean Palo Alto is inexpensive or that demand has disappeared. It does mean that the assumptions that once drove automatic appreciation are being re-examined. The luxury market here is learning that even in areas with strong job bases and school districts, buyers have limits when it comes to price, process, and risk.
Number 2. Palos Verdes.
You arrive in Palos Verdes, long viewed as one of the most exclusive stretches of coastline in Southern California. For years, understated homes on winding cliffside streets have sold for extraordinary sums simply because of their panoramic ocean views and proximity to major Los Angeles job centers and highly rated schools. That pattern is beginning to shift. In the luxury tier, listings that once pushed $4 million and beyond are now being reduced from their peak pandemic asking prices. Overall activity in the very high-end brackets has slowed, and some properties are remaining on the market far longer than owners or agents expected. Several forces are at work. Across the greater Los Angeles region, employers in entertainment, technology, and professional services have gone through restructuring cycles. More roles now allow hybrid or fully remote arrangements, which means fewer buyers absolutely need to live on the peninsula. At the same time, many higher-income households have discovered they can move inland or out of state and dramatically cut their housing costs while keeping much of their income. Carrying costs on expensive homes in Palos Verdes remain substantial. Property taxes on multi-million-dollar homes are significant, and insurance premiums have risen as companies reassess earthquake risk, wildfire exposure, and coastal erosion concerns. When buyers add up the full yearly cost of ownership, including taxes, insurance, and ongoing maintenance on older or custom-built properties, the headline price takes on a different meaning. Regulatory and permitting processes in this coastal area can also be lengthy. Stories of extended timelines for remodel approvals are common, especially for projects that touch foundations near the bluffs, alter views, or change the profile of a home in a way that could impact neighborhood character. Renovations that might be straightforward in other regions can require multiple rounds of review here. This does not mean Palos Verdes has become inexpensive or that demand has disappeared. It does mean that the assumptions that once drove nearly automatic appreciation are being re-examined. The luxury market on the peninsula is learning that even in communities with dramatic views, respected schools, and access to a huge job base, buyers have firm limits when it comes to price, process, and long-term risk.
Number 1. Los Angeles. You finish this tour in the greater Los Angeles area, where hillside views, palm-lined streets, and sprawling neighborhoods have long supported some of the largest and most varied luxury markets in the country. In 2025, parts of that landscape show clear signs of strain. Across several high-end neighborhoods, properties that once sold in the $3 to $5 million range are now listed for significantly less, yet remain on the market for extended periods. Some homes have sat for 200 days or more without closing, even after reductions. The term that some local professionals use quietly is idle inventory, properties that are not distressed in the traditional sense, but are simply stuck. Multiple factors contribute to this slowdown. Concerns about crime and the condition of certain public services influence where buyers are willing to commit long-term. Reports of increased fire risk in hills and canyons have led insurers to reevaluate their portfolios, and in some cases, drop or decline to renew policies, especially for older homes with challenging access. New buyers can face quotes for coverage that would have been unthinkable a decade ago. In addition, many of the region's luxury developments are governed by associations that manage roads, security, or shared amenities. When severe weather or landslides damage private infrastructure, those associations may levy special assessments running into thousands of dollars per household. Disputes over responsibility and cost can end up in court, adding another layer of uncertainty. Environmental history matters as well. Some properties sit on land that has seen prior industrial use, older utilities, or complex geology. When buyers discover issues such as soil contamination, aging pipeline easements, or unstable slopes late in the process, it can lead to renegotiation or cancellation. Word of such incidents spreads quickly in high-profile markets. Los Angeles promised glamour and possibility, and in many ways it still delivers both. But its luxury housing market in 2025 also reflects the broader transition playing out across California. Insurance constraints, climate risk,
infrastructure costs, and changing preferences are all reshaping what it means to own at the top of the market.
You have just taken a tour through some of the most closely watched luxury markets in the state. Places where million-dollar discounts do not necessarily equal safety or value. Price drops may look dramatic on a chart, but once you add in landslide risk, fire exposure, insurance limits, association obligations, and regulatory complexity, the true cost of ownership becomes clear. Before you fall in love with marble kitchens and hillside pools, ask whether the long-term risks fit your financial and personal reality. Comment below and tell us which city surprised you the most, or share your own story of navigating an expensive market. If this deep dive helped you see beyond the listing photos, tap like, share this video with anyone dreaming of a California luxury home, and subscribe to Discover the Nation so you never miss our next investigation.